Welcome to the Fear and Greed Daily Interview. I'm Adam Lang. The Reserve Bank has started to wind back its emergency levels of support as the economy continues its better-than-expected recovery. At its July meeting yesterday, the board of the RBA kept the official cash rate on hold at 0.1%, but declared it would scale back its bond buying program. To explain what it all means, we've gone to one of Fear and Greed's favourite economists, Dr. Shane Oliver, Chief Economist at AMP Capital. Shane, welcome back to Fear and Greed.
Thank you for having me, Adam.
It's a pleasure. Were there any surprises for you yesterday afternoon in the RBA announcement?
Not really. In fact, the only surprise to me was that there were no surprises. Key elements were that I think the Reserve Bank was on track to take some baby steps away from the emergency stimulus that it put in place last year, but it would still want to sound pretty dovish given the uncertainty still facing the outlook, particularly in terms of coronavirus, but also in terms of the likelihood that wages growth will only pick up gradually over time at a macroeconomic level. So I can't say that I was particularly surprised, and I tend to agree with what the Reserve Bank is doing here.
In simple terms, and perhaps along the lines of those baby steps, how significant is the reduction in the RBA's bond buying program?
It's probably the main one and the one that people can most easily get their heads around. I must admit some of the other things they do can get very confusing. But basically, starting late last year, the Reserve Bank announced a quantitative easing program which involved buying $100 billion worth of government bonds over 6 months. And these were to be long duration government bonds. So it already had in place a 0.1% yield target for 3-year bonds. But there was an issue that beyond the 3-year period, bonds were free to go wherever. And of course, it didn't want to see a pickup in bond yields, particularly given that other central banks were aggressively buying their bonds and effectively injecting cash into their economies in the process. So the Reserve Bank, partly motivated by a desire to match other countries and to avoid being seen to be too tight and therefore allowing the Australian dollar to rise too quickly, announced their own program. The initial program ran out to April this year. The Reserve Bank announced earlier this year that it would extend that program by another 6 months out to September this year, again to the tune of $100 billion. And the big decision was going to be around what would they do beyond September. And of course, the Reserve Bank for the last few months have announced that they would review it at the July meeting and make an announcement, which of course is what they've done. They're basically, it doesn't quite work out, but basically they were buying about $5 billion worth of government bonds a week. And these were buying bonds in the secondary market. So they weren't actually giving the money straight to the government. They were giving the money to banks and others who held those bonds and injecting cash into the economy. They're now saying that they're going to cut that back to $4 billion a week. So it's a relatively minor cutback, and that they would keep it going at least till November, at which point in time they will review it again. Presumably looking to see how quickly the economy continues to recover and what the Fed does in terms of its own bond buying and whether it indeed undertakes some sort of tapering, which would enable, therefore, the Reserve Bank to continue to slow their pace of bond buying. I guess the question is, how does that affect the average Australian? Most people would think, well, this is all very technical. But when you buy a government bond, when a Reserve Bank buys a government bond, all things being equal, it pushes its price higher, demand for more demand, higher price. And of course, when you push a bond price higher, it pushes the yield lower, or keeps the yield lower than it would otherwise be. And that, of course, has been a factor in keeping bond yields lower than what might otherwise have been the case. And it was also a factor contributing, therefore, to lower fixed mortgage rates over the last 6 to 9 months. Low bond yields have meant a low cost of funding for the banks on a 2, 3, 4, 5 year horizon, which has meant that they've been able to offer these extraordinarily low fixed mortgage rates, in fact, in some cases below 2%. So the Reserve Bank is still buying those bonds, but that downwards pressure on the bond yield will start to abate as they buy less of the bonds. So it could mean over time higher fixed mortgage rates.
And do you see that coming in the nearer term? And by that I mean within 12 months, or do you think it'll go a little longer than that?
I think it's going to be a very gradual process. We've already seen some backup in long-term bond yields. At their low point last year, the 10-year bond yield was down as low as 0.6%.
Right.
The last few days, it's been hovering just below 1.5%. So we've already seen a backup in bond yields, and in the process, fixed mortgage rates have moved higher, not dramatically so, but it has become harder to get those deals where you can borrow for 4 years at less than 2%. I suspect that as the recovery continues in Australia and globally, and I'm assuming it will continue, albeit with fits and starts along the way, some of them determined by coronavirus, that will mean a gradual rise in bond yields and therefore, by implication, a gradual rise in fixed mortgage rates in the process and other longer-term borrowing costs in the community. But the emphasis will be on very gradual. Central banks are not actually stopping their bond buying, or certainly not reversing it. They are still buying bonds, so that will keep bond yields lower than might otherwise have been the case if it were a normal recovery.
They are extraordinary settings, really, $1 billion a week less, and that flows through to the general economy. And as you say, some of it's perhaps even visible now. No one was expecting interest rates to move yesterday, given the Reserve Bank language and Governor Philip Lowe having been very clear that they wouldn't change until 2024 at the earliest, although the language around that target has started to evolve somewhat. Shane, how are you reading the tone of the Reserve Bank comments?
Well, the language basically switched from basically saying that we don't expect the conditions to be in place for a rate hike until 2024 at the earliest. Now they've changed that to saying, and I'm going through the pages here, that their central scenario is that the condition for a rate hike will not be met before 2024. So they've tweaked it slightly,
right,
I guess, to say, there's a greater chance it could be at least in 2024, and maybe there are some scenarios where it could occur earlier, but their central scenario is 2024. So they've sort of opened up the possibility that a rate hike could come earlier than 2024, whereas before they were saying 2024 at the earliest. So in that sense, you could say this is a somewhat more hawkish twist.
Yes.
The economists might have their other views on that. Financial markets were a bit mixed in terms of their interpretation. The Aussie dollar did go up a little bit. It went from 75.60 to 75.90 sort of thing. Not a huge move, but still a rise. The share market came down a little bit and the bond yields rose a little bit. None of those moves, I'd say, were huge, but nevertheless, they're probably consistent with a slight hawkish twist by the RBA. Now, the flip side to all of that is you could say, well, this is all semantics. You're getting hung up on words here. They're still talking about 2024. That's still several years away before we get there, maybe 3 years away before we get to that point. So you shouldn't get too hung up on any of this stuff. That said, my own view is that a rate hike will come earlier than 2024. For most of this year, we've been of the view it will probably come in 2023. It's only recently that anybody's started to show much interest in that. And of course, many economists are now saying 2023. So it's become pretty much consensus. And that's largely been because the economy has recovered faster than the Reserve Bank was allowing for. We're one of the few developed countries where GDP is above its pre-coronavirus level, where the jobs market is stronger than it was pre-coronavirus. And that, of course, has meant that the Reserve Bank needs to reflect that. But it's also, I think, brought forward to some degree the timing of the first rate hike. And so even though 2023 itself is still a long way away, I think it will occur a bit earlier than the RBA's 2024. So you can go around in circles trying to read things into these statements, but I think at the end of the day, the Reserve Bank has, if anything, become a little bit more hawkish, but in a big picture sense, it's still ultra dovish to the extent that it's still referring to 2024, which is still a long way away.
And they have been emergency settings and they're now looking or starting to ease those. In terms of the basket of factors that the RBA is considering to shift rates, do you have things that you really look closely at that you think, oh, these are the ones to watch in terms of what are the factors that are going to lead to a shift in decision?
Yeah, normally I look at the state of the economy, obviously, levels of confidence, both business and consumers, the level of GDP relative to where it was prior to the shock. All of those things have moved in a direction consistent with rate hikes coming onto the horizon. The more specific things one would look at is the state of the jobs market. And if you think about the last few years, the problem for the Reserve Bank and indeed the Fed is that wages growth has been too low relative to their inflation targets. So the last time we had wages growth above 3%, I think was around 2012, 2013. So that was a long time ago. And then surprise, surprise, the last time we had inflation consistently within the target, 2 to 3%, was around 2014. And so we've had a long period where wages growth has been too low. If you sort of roughly assume that you're going to have productivity growth of, say, 1%, that's conservative. The intergenerational report released by the government was assuming 1.5%, but let's go with 1%. Assuming it's something like that, then you at least need wages growth of 3% or more to be consistent with prices growth of around 2 to 3%. And you could argue that 3% will only give you 2% inflation on a sustained basis. So you can understand where the Reserve Bank is coming from here. They're basically saying that we really need to get back to 3% plus wages growth. To do that, we need full employment. We need a much tighter labour market. We've been debating about what the level of unemployment is that would be consistent with 3% plus wages growth, and I suspect that it's probably closer to 4% than just below 5%. So that's what I'm looking at. If we see the jobs market continue to improve rapidly, as it has lately, unemployment heading towards 4%, and underemployment, which is currently around 7.5 to 8, if that heads down towards 6, then I think the conditions would be in place for wages growth to be sustained above 3%, and therefore for the Reserve Bank to raise interest rates. So that's the way I'm reading it. They basically said that we're not going to jack up interest rates just because we're forecasting higher inflation, but they will only jack up interest rates if they actually get sustained inflation in the 2 to 3% target. But the key to watch, I think, is the jobs market, lower unemployment down towards 4%, and wages growth being sustained above 3%. So obviously, if we get a bit of a spike in inflation in the current quarter, as the drop in childcare over a year ago drops out of the annual calculation, and because of higher petrol prices, then the Reserve Bank will simply look through that and say, well, that's not enough. If we hear some wages going up in some areas because of an absence of foreign workers or backpackers, then the Reserve Bank would likewise say that's not enough. We need to see sustained strength in the jobs market and sustained wages growth above 3%.
It's a great explanation. Thank you. Stay with me, Shane. We'll be back in a minute. My guest this morning is Dr. Shane Oliver, Chief Economist at AMP Capital. Now, there was something of a tremor in the force yesterday. The Reserve Bank is reasonably optimistic, but confidence data out yesterday showed consumer confidence last week fell following the introduction of lockdowns across the country and led down by Sydney, no surprise there. Can falling consumer confidence impact this recovery?
Well, it could, and that drop in confidence has been consistent, I guess, with what we've seen for a while now, that every so often we have these lockdowns, and of course when they happen, people get depressed, and that impacts things in the short term. Now, the track record since the South Australian lockdown in November up until the recent Victorian one is that after each of the lockdowns, they're relatively short, the number of cases comes under control and the restrictions are removed, and things quickly bounce back, including consumer confidence, spending, mobility, which is measuring how many directions people ask for on their mobile phones and so on. So that's been the track record so far, but obviously we're still waiting to see what happens in Sydney. My feeling is that they could have announced the lockdown earlier. I know there's a whole range of dispersion of views on these things these days. I mean, if you want to get into an argument with someone, just mention lockdowns. Or Bitcoin, Bitcoin's the other one.
Either one will do it.
Bonkers, just say something negative about Bitcoin on Twitter, you'll get pummeled. But lockdowns are fairly similar. I'm in the camp that says that a healthy economy, a healthy nation is consistent with a healthy economy. And if you can keep coronavirus to a minimum, then you'll have decent economic growth and decent economic activity. And we've done that by lockdowns, by restrictions, and those short lockdowns have headed off longer lockdowns. The one time where we didn't do that properly was in Victoria. We left it too late to announce the lockdowns. The stage 3 lockdown in July only started July 2020, only started when there were over 60 new cases, and the stage 4 lockdown in Melbourne started in August when there were over 600 cases, whereas New South Wales got in there a little bit later than they should have, I reckon, at around 20 new cases. But still far better than Victoria did a year or so ago. So that gives me confidence that it'll come under control and the lockdown will be relatively short and therefore things will bounce back. But, it is a source of uncertainty, and that was acknowledged by the Reserve Bank yesterday. But hopefully, if we all do the right thing and the lockdown ends soon, then history tells us, the recent history anyway, that we bounce back pretty quickly. I think it's different when you're going into a lockdown of unknown duration. and gross uncertainty like we did in relation to the first one. You need things like JobKeeper. But the snap lockdowns we've seen more recently have all been pretty brief, and they don't have anywhere near the devastating economic impact. And I think people mostly know that they're heading off a worse situation, and therefore they go along with them, and then you get all this pent-up spending and it pops out the other side. I live in Avalon. I had my own cluster over Christmas, so I don't like having another lockdown now, but by the same token, I reckon this is better than enduring a 4-month lockdown like Victoria did in the middle of last year.
So amongst that, the lockdowns, one of the things that has only just started to change a bit is house prices. They're always a factor to note, and they have been very strong this year. What did you make of the RBA commentary on house prices?
Well, the RBA still seems rather relaxed about it, which I think is surprising. Their paragraph on house prices wasn't much different to what they said in the previous month, which wasn't much different to the previous month. They're still monitoring things and just warning that lending standards need to be maintained. I'm a little bit more concerned. I reckon when house prices surge, inevitably that leads to a deterioration in lending standards. I do worry that people are getting in with ever higher debt levels. We hear all these calculations that if you cut interest rates to these ultra low levels, it could result in a 30% lift in house prices. That's just simple maths. If you cut interest rates, people can borrow more, they pay more for house prices. Initially, they might get in. If they're the first one in there, they might get a bargain, but after a while, everyone's doing that. The house price goes up, and the only winner is the baby boomers and the developers. So I'm happy because I'm a baby boomer, but I do feel from a longer term economic sense that it's not necessarily the best thing to do. And also from a distributional sense, I think it's a bit unfair the way so many Australians are getting priced out of the market. Well, it's grossly unfair, to be honest with you. I think younger people should have the same opportunities I had. But the problem for the Reserve Bank is that they don't target house prices. They target financial stability and they target the broader economy. So they can't raise interest rates in this environment. Well, not yet anyway. At some point they may be able to, but not yet. So they have to turn to what you call macroprudential controls, which is tightening lending standards. And I'm therefore a little bit surprised that they're not doing that already, because history tells us that when house prices take off like they have, we've just had the strongest growth rate over the last 12 months since 2004. Sydney Sydney house prices over 6 months of this year have had their strongest gain since way back in the 1980s. This is real boom time stuff.
And it's across the country.
It's pretty much across the country. The only areas which are lagging a little bit are inner city units in Sydney and Melbourne. But even there, they've started to lift again. That, I think, will lead to longer-term problems, aside from just poor affordability, but it could lead to debt problems, particularly when we're encouraging people to get in with loan-to-valuation ratios of 95%, or in some cases 98%. Some of those people might eventually run into trouble. So I don't think that's a healthy thing, and the only way to offset it is macroprudential controls limit the supply of debt, because you can't, unfortunately, control the cost of that debt given the need for the rest of the economy to see still low interest rates.
So, Shane, we'll have to keep in touch with you on that particular one. Lastly, Shane, I know that you're a big pop music fan. Ed Sheeran has confirmed recently that Kylie Minogue and Jimmy Barnes will record backing vocals on a new song he's written called Visiting Hours. He wrote the song for Michael Gudinski, who sadly passed away relatively recently. Jimmy and Kylie and Ed Sheeran together at last. Are you looking forward to that one?
I am. I think that's a good move. I mean, Jimmy, I'll be honest here. I'm not a pub rock fan, but I like it. I'm not heavily into it, but I like it and I appreciate it. And whenever you listen to that Australian sound that was associated with Mushroom Records or Albert's, if you know Albert's.
Last year Albert and Son.
Albert and Son and Ted Albert, who was the guy who took them, one of the sons who took them down that pop path in the 1960s with the Easy Beats.
Yes.
And these are amazing stories when you look into what Gudinski did for Australia, what you look at what Alberts did for Australian pop music. It's a fantastic sound that I really appreciate. Ted Mulry and all these others, when I think back to the 1970s. Kylie, I have to say I'm a massive Kylie fan. I think I've been to every concert she's done since 2000.
They're pretty big productions. Since
Light Years album came out, and they're huge productions. I was incredibly depressed when I heard that she was ill over a decade ago now, and the concert had to be cancelled at the time. But to see her just keep pushing on and coming up with new albums year after year, going from country to disco. When you look at the albums, her name is frequently against all the songs. And that's impressive stuff, and they're great songs. And I think she's a great export for Australia, as Jimmy is. So to see them come together with Ed Sheeran, I think is a great thing. And I'll be out there buying that, or these days you don't buy it, you listen to it on Spotify. Music is one of the things that I think has kept me going through this pandemic period because...
Oh, you're not alone there. Sadly, they can't perform enough.
I know, you can't watch it. I mean, you try and support them.
Absolutely.
But it is a bit hard without the concert and the performances occurring. But yeah, were it not for music and Kylie's disco album last year, I would have had a tougher year. So thank God the music kept coming.
Thank God for disco. Shane, thank you so much for talking to Fear and Greed.
Thank you, Adam. Thanks for having me.
That was Dr. Shane Oliver, Chief Economist at AMP Capital. This is the Fear and Greed Daily Interview. Join Sean Aylmer every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Adam Lang. Enjoy your day.